Welcome, and thanks for tuning into KBRA podcasts. We cover topical research discussions, industry commentary, and more. As we continue to expand globally, KBRA Podcast is a go-to source for timely briefings directly from our knowledgeable team members. Senior Directors Ashley Phillips and Brian Ropp of KBRA's Financial Institutions Group take us through the third episode of Bank Compendium Insights, which features a discussion around our views on the U.S. banking industry's fourth quarter of 2020 performance during the pandemic. They also share observations about our long-term rated banking universe, focusing on key performance and credit metrics, as well as KBRA's expectation for the banking industry and items that they are closely monitoring as the economic situation continues to play out over the next several quarters. Stay tuned to learn more.
Good day, everyone. Welcome to the fourth quarter 2020 edition of our Bank Compendium Insights series. We hope you'll enjoy this update. Please feel free to follow us on LinkedIn at Kroll Bond Rating Agency and like the post for the podcast to help us increase awareness. So let's get started, Brian. Can you remind us of the banking population included in this research?
Thanks for the lead in. KBRA's Bank Compendium analyzes the quarterly results of U.S. banks within the KBRA long-term ratings. Our report covers about 110 of our 140 total KBRA-rated banking institutions that have a median asset size of around $7.5 billion, while those not included are privately held banks. Ashley, now that we have briefly touched on the population of the compendium, what other interesting facts can we share with our listeners about KBRA's rated bank universe?
Well, I'd first point out that we published over 30 new bank rating assignments in 2020. We have had some isolated individual bank outlook changes to negative as our rated universe continues to navigate the challenges of the pandemic. But our rating outlook for U.S. banks still remains stable, which we will outline in more detail later on in this session. And shifting into the specific content now, in your view, Brian, what would you say were the most essential takeaways from the fourth quarter compendium?
Well, to start, I would say that the fourth quarter closes the record books on a year that we would all like to forget. I think what we have learned from the fourth quarter is that the economic recovery was stronger than ever imagined earlier in the year, with positive momentum for the banking industry projected into 2021. The unparalleled government stimulus, both monetary and fiscal, and with the easing of state lockdowns, supported GDP growth into fourth quarter 2020 following the wild swings in preceding quarters. Ashley, from a high level, how would you say that earnings have held up?
Good question. The banking industry benefited from the beginnings of economic recovery as the majority of our rated universe reported a positive trend in earnings. A key factor driving this improvement was undoubtedly the continued steady performance of banks' loan portfolios and the progressively lower provisioning for the third and fourth quarters. The fact that median ROA has remained positive despite significant provisioning in 2020 overall speaks to the resiliency of the U.S. banking system. And Brian, continuing on the theme of provisions, can you expand upon your observations in the fourth quarter?
Great question, Ashley. And because asset quality was definitely a standout theme in the fourth quarter, where despite 7 basis points increase in the median loan loss reserve, there was a decent number of banks which released reserves on the back of stronger economic performance, shifts in loan portfolio mix, and their underlying loan portfolio performance. We also saw a large swath of our coverage universe report higher percentages of classified and criticized loans, although not to a level that signifies serious credit concerns, but something that we're definitely monitoring. Beyond provision expense, Ashley, how did net interest margins hold up with the Fed maintaining their zero interest rate policy?
The reversal in recent NIM trends was a positive component to earnings growth for the period. Part of this is that the banking industry continues to benefit from deposit repricing. But also, as the loan forgiveness process is now underway, banks have seen some short-term margin support from the recognition of deferred PPP loan fees. And next, let's drill down into more detail and interpret the latest key credit profile trends for the banking industry.
We've yet to see a meaningful increase in non-performing assets, which typically leads to a significant rise in loss rates. Another positive sign for credit quality is the dramatic reduction in deferred loans, as we had seen this portfolio as a key indicator of pending credit problems. Lastly, as I mentioned earlier, we have seen criticized and classified loans grow while remaining contained, which has been supported by recent stimulus programs and economic improvements. I mentioned the favorable trends in loan deferrals. How can you fill in some of the details there, Ashley?
Yes, average loan deferrals within our rated universe decreased to roughly 2% of total loans at year-end 2020, from a peak of around 15% earlier in the year. The concentration of deferrals remains highest in the hospitality and hotel sector, as well as the retail segment. Seeing as hotel is definitely an area of interest for investors, what color can you add about hotel deferrals?
So in general, hotels represent the second highest concentration among deferred loans category, which you highlight as having materially declined in the fourth quarter overall across our bank portfolios. Recent trends for the industry have shown occupancy rates in major destination cities were averaging above the 40% level, which is typically a break-even level for the asset class. With that said, the exposure to our coverage is predominantly flag properties with relatively low loan to values and has strong sponsors. Ashley, what could you share about retail, which represents the largest concentration of deferred loans?
We note that the retail sector has experienced multi-year secular changes, which we expect to continue at an accelerated rate going forward due to consumer shifts to e-commerce. However, we would also mention that much of this exposure is underwritten to relatively low LTVs, and more importantly, is characterized by solid debt service coverage ratios. Also, retail exposure for our coverage universe is typically strip centers with grocery stores or pharmacies as anchor tenants, which have performed comparatively well.
So that would leave the energy and transportation sectors to round out the vulnerable exposure checklist, and our median coverage does not have a meaningful exposure to either sectors. It is also important to note that under the CARES Act, deferrals are not required to be marked as a non-performing or a troubled debt restructured, which is possibly masking underlying credit-related issues. Deferrals were allowed for up to 6 to 12 months, so it may be until late 2021 until we truly see the credit challenges inherent in the deferred portfolios. Ashley, speaking of masking underlying credit losses, have we seen any credit losses materialize as of yet?
Loss rates have actually continued to track at historically low levels, with an average net charge-off ratio of 17 basis points for the fourth quarter. While it certainly could be expected that loss rates increase in 2021, we view the loss absorption capacity for most rated banks to be sufficient, with the median reserve coverage of 147 basis points of total loans. Brian, how does this compare to the global financial crisis era?
So I see two major differences between today and the global financial crisis. First being CECL, second being capital. Regarding CECL, you mentioned how the loss absorption capacity for most banks were sufficient, and much to the industry's chagrin, CECL deserves a lot of credit for this fact, as it's required banks to immediately reserve for future losses, effectively pulling forward the reserves. And the second would be capital. The increased capital requirements implemented post-global financial crisis has placed the banking industry in a position of strength going into the pandemic. Ashley, with capital being a true differentiator going into the pandemic, how has capital held up and what trends are you noticing?
The industry has continued to build capital through the pandemic as balance sheet growth has slowed, and many institutions have embraced a more conservative posture toward capital management. Debt capital markets have helped bank holding companies enhance their capital levels via subordinated debt and preferred stock issuances as well. And given these dynamics, what's the latest on the liquidity front?
Given the liquidity boost to the banking system as a result of the significant fiscal and monetary stimulus in 2020, banks have been able to reduce reliance on non-core funding sources and to lower funding costs. The banking industry continues to benefit from deposit repricing, as well as core deposit growth, which has allowed many banks to run off higher cost funding. In some cases, we even saw banks take a charge for the prepayment penalty related to FHLB borrowings as they restructured the liabilities and taking advantage of excess liquidity to improve funding costs for future periods. So what would you say are the median deposit costs now compared to a year ago, Ashley?
96% of our rated universe reported lower deposit costs sequentially, with the median cost of deposits down 8 basis points to 33 basis points for the fourth quarter, which compares to 92 basis points in the year-ago period, or an approximately 40% deposit beta. So I'd say that about covers the fourth quarter, but what are KBRA's profitability expectations for banks going forward in 2021?
So we're expecting ongoing, though moderating, pressure on core net interest margins in the near term. The loans with structured floors have mostly reached them. Pressure on loan yields appears to be slowing, though, in part due to the recognition of fee income from PPP loans. We began to see early signs of momentum in PPP loan forgiveness during the period, though roughly 90% of average PPP loan balances within our coverage universe remain at year-end. As the loan forgiveness process continues, banks will see short-term margin support from the recognition of deferred PPP loan fees. With that, what are KBRA's credit quality expectations in the coming quarters?
I would reiterate that the trends highlighted in the fourth quarter compendium continue to shed light on the overarching effects of the pandemic on the industry. While we don't have a defined projection for ultimate losses through this cycle, we anticipate that problem credits will remain manageable relative to core earnings and capital, particularly because early on, banks boosted loan loss reserves, as you mentioned. The earnings picture continues to improve, barring any unforeseen surprises. Brian, what additional thoughts do you have on bank capital for this year?
So with banks retaining and building capital into 2020 by suspending their share buyback programs and at times their dividends, we expect core capital to continue to grow into 2021, but at a slower pace. We're already seeing more share repurchase plans being reinstated and expect this to continue as banks become more comfortable with their credit portfolios and the economic outlook.
And what is our forward view for liquidity and funding?
So liquidity and funding remain defensively positioned for the majority of the banks, with the trend of excess on-balance sheet liquidity may negatively impact near-term industry earnings. KBRA has generally taken a favorable view of fortressed liquidity positioning on banks' balance sheets. With that said, excess liquidity offers us some clues to the underlying economy, as strong excess liquidity signifies consumer and commercial businesses remain cautious over the economic outlook. As excess liquidity begins to be deployed by depositors, this will be an initial signal as a turn in the consumer and commercial confidence, which will lead to companies beginning to invest, withdrawing down their lines of credit, which will ultimately migrate to loan origination as businesses borrow money to invest in capital expenditures, plan expansion, M&A, etc. So as loan demand returns and interest rates rise, we believe that many banks will retain more of the liquidity built from this cycle, which will allow them to better fund growth through their core deposits, potentially leading to a meaningful margin expansion. Ashley, I laid out the key signposts for the return to economic demand. What are KBRA's views on earning asset growth for 2021?
We're watching to see what transpires in terms of earning asset growth, which we expect to remain a challenge, particularly on the loan front. By and large, loan growth was contained to PPP in 2020, as the economic conditions and high degree of uncertainty hampered lending into other areas for many banks. While organic loan originations may increase in 2021, this could be essentially offset by expedited PPP loan forgiveness through the first half of the year. We do expect banks to engage in the latest round of PPP, but possibly at a relatively lower degree than last year. For example, about 10% fewer institutions were participating in PPP as of the end of January 2021 compared to participation in 2020. Brian, how else do you see this past year influencing the future of the banking industry?
So the banks in KBRA's coverage universe are typically relationship-oriented commercial bankers who serve small to middle markets businesses with commercial real estate lending. We are monitoring several secular shifts within the retail space impacted by online shopping, office space impacted by work from home, and the multifamily asset class impacted by outmigration away from several gateway population centers like New York City, San Francisco, and Chicago.
Good color, Brian. Obviously, mortgage was a bright spot in 2020. What are our expectations for mortgage banking in 2021?
So the second and third quarters of 2020 were record-setting quarters for mortgage origination. Many of our banks with mortgage operations reported declines, though, in the fourth quarter, however, still at levels well above historical norms. Anecdotally, we've heard purchase volumes were on the rise in the fourth quarter, though. So, with low historical mortgage rates and a robust housing market, we expect a solid year for mortgage banking in 2021, but to more stabilizing levels. We have also seen mortgage spreads decline, which have returned gain on sale margins to less gravity defying levels. Ashley, apart from share repurchases and dividends, how do you think banks may deploy excess capital this year?
In our view, bank mergers and acquisitions are likely to pick back up, perhaps in the second half of 2021. And this would, of course, be contingent upon favorable market conditions, continued improvement in the economic environment, and more clarity into the credit side of things. Some management teams are already communicating the desire to consolidate if and when the right strategic opportunities arise. Ryan, can you tell us more about how banks are remaining competitive in this lower rate environment with the near-term growth limitations we've mentioned?
Actually, that's a great question. And there are several areas of the balance sheet and income statement that banks have been focused on. We've seen bank management teams using the standard economic slowdown playbook, if you will, by rationalizing their cost base to help offset declining or flattening revenue. Rarely a week goes by that a bank doesn't announce a branch reduction plan, and we've had several banks announce early retirement plans to reduce personnel costs. Another key theme that has also been getting more attention and goes hand in hand with staffing reductions has been the significant pull forward of technology and benefits as banks rethink the delivery platform and how they reach their customers. KBRA recently published a report on exactly this topic called Technology and Banking Accelerating into the Future that our listener may want to check out. And lastly, if I could dovetail your earlier comment on M&A, it will likely pick up as banks find it difficult to grow their top line and they realize that consolidation offers a pathway to better returns provided by scale and cost reductions. A key hurdle for many to overcome remains gaining comfort with another bank's credit portfolio. So Ashley, we alluded to our rating outlook for banks remaining stable, even though last year was such an unprecedented year. Can you elaborate on the thinking behind our view?
There's no disputing the eventful nature of 2020, but we like to point out that we communicated that our rating outlook for the banking sector was stable, even early on in this pandemic-driven downturn. And we still maintain that same stable rating outlook now. Thus far, the banking industry has continued to demonstrate financial resiliency and has managed through this stress period in a much stronger position, particularly relative to pre-global financial crisis.
Right. And as a point of reference, how have KBRA bank ratings withstood this test?
KBRA's ratings are designed to be durable through the cycle. The few banks with realized credit missteps and/or comparatively weak core depository funding or capital profiles have been placed on negative outlook or downgraded. At an unchanged median senior unsecured debt rating of BBB at the parent level, our rated banks are quite resilient in our view. We feel very comfortable with our ratings in the context of probability of failure. So Brian, back to you. What final thoughts could you share?
So as an industry, banks have outperformed our initial expectations from last spring. While credit uncertainties remain, KBRA's rated universe of banks and the banking industry as a whole appears to have built a solid foundation to weather an increase in credit losses should they materialize, having reserved for much of the cost upfront in 2020. Of course, we continue to closely monitor the operating environment and the associated credit profiles of our rated universe as the economic situation plays out over the next quarters. So for closing remarks, we'd like to thank all of our new and returning listeners for tuning in today.
We hope this edition of the Bank Compendium Insights podcast was valuable, and we look forward to catching up with you again next quarter.
We will also be releasing an on-demand webinar on February 16th, where Ashley and I will share our updated thoughts on the U.S. banking sector. Sign up to receive our financial institutions emails at kbra.com to guarantee your access link.
And please feel free to reach out to us anytime with questions. We are always happy to be a resource to investors. And we're signing off. Until next time.
This concludes our episode. Feel free to continue the conversation on LinkedIn and Twitter at Crowbond Rating. Also, don't forget to check out KBRA Financial Intelligence, KFI, a new generation of data-centric applications. They deliver a broad selection of timely and accurate financial data, covering the U.S. banking system and the broader financial industry, that puts thousands of fundamental data points and ratios at your fingertips in real time. Our platform provides a foundation for deeper analysis and rapid data discovery, helping you go beyond the numbers to uncover unique insights. KFI's rich datasets and intuitive applications support a wide range of core workflows for bankers and analysts. Build detailed valuation and merger models using our Excel add-in tool, or quickly visualize time series data in our web application. Our applications harness the power of data to help you discover actionable ideas and make better decisions. KFI, Data and Analytics for the Financial Community. Learn more today at kbraanalytics.com/KFI.